It's a new year. Are you confused about investing? It's hard. I know. I did it for a long time. I was you. I had no clue what I was doing. And I didn't even have a YouTube. I had stupid friends telling me to invest in stupid companies. But you're in luck. You found this channel.
Call this 1-800 number below.
You found this video, and you found Paul and I sitting in his Mexican mansion right now, ready to teach you about how to analyze the price and financial health of a company. Now, I know what you're thinking too. All of your friends are telling you to buy Bitcoin, Tesla, and NIO. It's what they do, Paul. They won't stop. We're not here to do that, okay? Here's what we're going to do, folks. I know you might be lost. I know you might be new to this, but it's a new year. We're going to teach you. We are going to look at a company that meets all of the 8 pillars that Paul uses to go. Paul, what are your 8 pillars? Tell people, if you've never heard of this, what are they?
PE less than 20.
Why do you use 8 pillars, Paul?
I use the 8 pillars as a 500-foot. People, then they write to me, they sit there and say, well, Paul, this hit all 8, but this hit 7 pillars. Should I buy? The 8 pillars are merely telling me a story. I, over time, had just started to gravitate towards 8 different things that I always looked at. One day, we just started deciding how we're going to do this process, and it came up as 8 pillars. My whole idea isn't to say, oh, it hits these 8 pillars, they have them all, let me buy this company. It's merely tell me a story. I have enough investing and business experience that I'm trying to teach everyone that we can all learn together to sit there and say, okay, based on what I see here, what are the questions I need to ask about this company before investing? I can do that. Now, based on what we're doing right now, I believe there are 22 companies in the United States over $500 million in market cap that qualify and get all 8 pillars of the check mark. I exclude all utilities, all banks, and all energy companies just because I don't understand how the financials work in there. Oh, and insurance. But the 8 pillars are merely used as a way for me to sit there and say, okay, let me now start doing a deeper dig into this company. So what we decided to do was Seth had a good idea. Paul, let's pick an 8-pillar company that hits all checks that nobody even knows about. Now, do you want the list of all companies that hit the 8 pillars?
Don't spoil that yet. We'll leave that to the end of the video. Here's the point, Forks. I know this guy, everything he said might seem pretty confusing. Here's the point. While all of your friends are chasing down those hype stocks that just keep rising and rising and rising, and you have no idea why, the idea of buying high and selling low is not investing. You want to buy low and sell high. So let's not chase those. Let's find companies that are currently undervalued.
Because they're overlooked.
So we can,
and then wait till...
Diamonds in the rough. That's right, Paul. Diamonds in the rough that are undervalued, so we can buy low and then make a huge profit on them. So
and one of the most common questions I get is,
go ahead.
What if they're never, ever found? That doesn't happen. And your goal is to buy 20, 30, 40 companies that all fit these certain metrics. Because at the end of the day, you will be wrong on several, you'll be really right on several, and a lot of them will perform the way they should perform. People will get attention. Right now, the markets are up a ton because of hype stocks. We're trying to find non-hype stocks. That way, when the hype stocks start to fall, people start going, wait a second, there's cash flow here and cash flow here and cash flow here and a dividend here. Let me go pay attention to that one. That's the whole goal of value investing, that eventually the stock starts to be worth what it should be worth.
So by the end of this video, you're going to know these 8 pillars, know how to use them, and get another rep in the discipline it takes to invest in good companies. So Paul, let's bring out our first company that you've never heard of and neither have any of your friends. We'll show you how to analyze it. Go ahead, Paul.
EBIX, EBIX. This is an insurance cloud provider. They provide software for insurance companies. Now, here's how much I know you haven't heard of them. I messaged a friend of mine who's a big insurance agent in Akron.
Okay.
And I said to him, have you heard of EBIX? And he said no. So I liked hearing that because I'm like, okay, well, there's maybe some room for growth with this company. They provide enterprise cloud e-commerce solutions for insurance, finance, and healthcare industry. The firm generates blah, 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 blah. Okay, they're located in Georgia. They're only a $1 billion company.
So their market cap is $1 billion. This is sort of what the world thinks the company is worth.
This is my price for the company. I don't care about the share price. I care about the market cap of the company because the market cap is the number of shares multiplied by the share price. This is what matters to me.
Our pillar number 1 is PE ratio, folks. We want this under 20.
And we have 12 here.
Beautiful.
The next pillar.
Pillar number 2 is profit margin. We want that above 10%, Paul.
We have 16% here. So we already have 2 check marks. As we said, all of these are going to be check marks, but 16% profit margin quarterly, pretty solid. Yeah, and they do pay a 0.8% dividend. So on $1 billion value, they're paying roughly $10 million a year on dividends.
Pillar number 3 is revenue growth, Paul. Obviously, we want the company, their revenue to be growing over the past 5 years.
Look at this growth, Uncle Seth. 265 to 580. Now, whenever you see a lot of growth in something, you want to make sure it's not done just through acquisitions. I want to make sure that the company is growing internally from its own methods of business development, having more salespeople, doing more advertising, et cetera. Does that mean acquisitions aren't good? No, it just means that fundamentally the business should be doing better on its own without acquisitions.
Pillar number 4 is profit growth. We want the profit to be going up. Paul, go ahead, show us the profit.
79.5 to 97, check mark. Now I will say this, that's kind of weird to me. Why is their revenue up over double, but their profit's only up 20%? So there's the first story that I'm already looking at going, okay, this has told me, even though it's a check mark, it is telling me go find out why their profit's only up 20%, even though their revenue is up over 100%.
Pillar number 5 is shares outstanding. We want the number of shares that the company has of the company, that number going down.
34.67 down to 30.5. So chickadee check in the house.
What that means, folks, is they're not diluting the shares. They're not selling off more shares, and thus your shares worth less. They're actually buying them back.
Correct. Now I'll give my analogy. Let's say a company has 10 shares outstanding. You own one of them. You own 10% of the business. Now let's say they decrease that. They buy shares back with their free cash flow to 8 shares. You still own your 1 share, but now there's only 8 shares outstanding. You now own 12.5% of the business. So they basically rewarded you with more ownership by using their free cash flow to buy back shares.
This is usually a confusing thing that normal folks like yourself might have heard. Hell, my mother said, I love stock share splits, Paul. She just loves it.
It's different than a stock split.
Go on.
A stock split's very, very different. And I'm glad you bring that up. A stock split does not affect does not dilute you at all.
Right.
This is when they issue more shares or for like an acquisition. Like, hey, I want to buy your company. We have 10 shares. I'll give you 2 shares of our company.
I see.
And then we issue 2 more shares. Now the 10 shares goes to 12 shares. So if I owned a share before when it was 10 shares and they go buy your company for 2 shares, now we have 12 shares outstanding. I now own one of 12 shares, which is 8.33% now instead of 10%.
Make sure you are tickling that thumbs up, pretty please. Paul has to pay the electrical bill in his mansion here on the Pacific.
And we need staff that's behind us.
That's right. We need all of your money, and all you have to do is tickle the thumbs up. Paul, pillar number 6 is current assets greater than current liabilities. We want to look at assets over liabilities.
Okay, so on the balance sheet, $347 million, and we have $198 million here. So check mark there. Definite check mark there. Plenty of money on hand to pay their current bills.
Pillar number 7 is free cash flow growth, the cash from operations minus the capital expenditures.
31 million to 48 million. So it's up about 50%. So check mark there. So do you have your calculator out? So
I'm sorry, show that calculation right now on the balance sheet. Go on.
Free cash flow is cash from operations less your capital expenditures. This is the money the business can use to pay dividends, buy back shares, make acquisitions, and do other growth things that the company's going to do to make your company, your investment better. So we look at the last 5 years to determine what's the average. Here in year 2015, they did 48 million minus 17 million, about $31 million in free cash flow. And last year they did about 48 million. So 31 plus 48. In between, let's call it 77, 66, 71. The average is 58.6. So call it 60 million average. Now, one thing I do have a concern about is the free cash flow is down over the last few years. So again, another question to ask. Why is free cash flow down from the previous 2 years and 3 years ago? You want to understand why that is. They might be spending more money on sales and other things on the operating side. They're going to drive down free cash flow, but it's a good investment long-term into their company to make free cash flow better long-term. That is okay. That is another reason why you don't just look at this check and go, oh, it's fine. Now, 60, what did we say what the number was? 60 billion. This is a growing company. I'm fine paying 20 times free cash flow for this. 60 times 20 is 1.2 billion. The company is currently 1.15 billion. Check mark. This might be a good play long-term for this company.
So what Paul just did is we found the free cash flow of the company. We multiplied it by 20 to find the desired market cap that Paul thinks the company
Why did
should.
I pick 20?
Well, that's you tell us.
I picked 20 because the company is growing. They doubled their revenue in the last 5 years. Okay. So to me, doubling the revenue in the last 5 years allows the company, you don't want to penalize them as their free cash flow is growing a lot by counting early years at the same ratio as current years. Like usually the number is 15 for free cash flow, just like earnings, PE ratio. But a fast growing company, you should be willing to pay more for a fast growing company than a slower growing company.
So Paul determined that the market cap is 1.2 billion.
That I'd want to pay for it.
But the real market cap is only 1 billion. It's currently underpriced by Paul's standards. And folks, the key is, we're trying to give you a process of thought instead of just chasing these hype companies you know nothing about. Tesla produced 500,000 cars last year, Paul, and everyone's buying it. Ford produces 500,000. I'm sorry, a month. Yeah, and so
I don't know if it's a month, but whatever the number is,
it's almost there. So yeah, it's 2.5 a quarter. So,
but Tesla's worth 30 times more than Ford.
So yeah, we want to find those undervalued companies you've never heard of. And here's the final key to bring it all together, Paul. These are the ways that a disciplined investor makes decisions that gets them these homes. If your uncle tells you about some stock at a backyard barbecue, just take a look at what he's doing. It's not the same thing. This is true discipline analysis.
Are we going to show the view, by the way?
Well, we can't at the moment.
Yeah, we can. We can spin it around, can't we?
I mean, kind of, but...
So first off, two things. Can you share my screen again?
Sure, Paul.
One of the things I brought up was their revenue growth, and was it caused by acquisitions? This is the cash flow statement. Now remember, guys, this is what we were talking about earlier. This software here, you're probably wondering, what is Y Charts? I pay almost $500 a month for Y Charts. We are creating the 8 Pillars website and app that will give you all this data for $25 a month. Or you can go to our Patreon, www.patreon.com/everythingmoney, and sign up for any of the levels. As long as you're an active Patreon user, you will get this for free when our website is done in the next few months. For free, as long as you're an active Patreon member. So, back to my point. I went to the cash flow statement to see, did they make acquisitions? There's a portion on the investing section called net divestitures and acquisitions. A negative number means money went out to buy a company. In the last 3 years, they've clearly made a lot of big acquisitions. 192 million, 227 million, 110 million. So, I would want to understand how much of these acquisitions added revenue and bottom line to the business, because the bottom line didn't grow so much, but the top line revenue did. But the profit was only up 20%. The revenue is up over 100%. So these are some of the questions to go deeper into to understand what acquisitions they made to drive their revenue and profit.
So I told you at the beginning of the video, you'd learn about this. I hope now you're going to need mental reps in this, folks. I've been hosting this show with Paul for a couple years now. And it's going to take some time. I'm not expecting you to understand this now, but if you can follow these 8 pillars, you can develop a process to looking at the health of companies and give you a better understanding whether you should or should not invest instead of following the crowd. We appreciate your time watching our videos. As always, make sure you subscribe, smash that thumbs up, and visit our Patreon. The link in description is below in the description. We have almost 200 members, and we do Patreon-only videos where we'll ask your exact questions you're wondering about investing in finances right here on the show. For Paul and Seth, I love you. Everything money, guys. Thanks so much.